What's up everyone, it's Karthik with MoneyVest. So welcome on board for our Market Open live stream. Today is the big day. We've got Jerome Powell talking at the Jackson Hole Economic Symposium in just over an hour. In about an hour and 20 minutes, we are going to hear from Jay Powell. His testimony begins at 10 a.m. Eastern or 8 a.m. Wyoming time. So we're going to be, of course, broadcasting that. And prior to that, we're going to be going over, of course, the markets. We are seeing a little bit of a recovery after yesterday's brutal sell-off. The Nasdaq 100 back over 86 basis points higher. The SPY is up a little bit over 60 basis points. We got Microsoft up almost 70 basis points. Nvidia is up over 1.2%. And Tesla is also up almost 1% on the day. So if my audio and video is good, just give me a thumbs up in the chat. And we are all ready and all set to go here. And also share this live stream with other people that might be interested in joining us to listen in to what Jerome Powell has to say in just over an hour. So I would really appreciate that. We're trying to get to 82,000 subscribers by the end of today. So that's going to be our goal. And Ray, thanks, Caddy, for broadcasting today. We all appreciate it. So thank you so much. It's been quite an interesting week. I mean, this week we have basically been flat. If you come over to the weekly time frame, you'll notice that the S&P 500 is just up over 34 basis points. We're slightly green, and the Nasdaq 100 is essentially flat. We're just about down 4 basis point right now. So this is going to be quite a decisive end to a very indecisive week so far. And Jay Powell, we've got a poll going on right now. Quite the unusual poll. What color tie is Jerome Powell going to be wearing today at the Jackson Hole Economic Symposium speech? So participate. We got black, red, blue, and purple. My vote is on purple, which is a little bit of an underdog right now. 23% of you guys expecting for purple or red. 19% black, and then we've got 35% majority people expecting for a blue tie. So again, vote, participate. We're trying to get to over 500 votes by the time Jerome Powell takes on the mic and starts talking. So again, thank you so much for joining, everyone. Really appreciate it, and we're ready to go here. Audio, video looking good. Excellent. Guy, helped me make 35,000 on a single trade in 2022. Matt says, that's awesome. Congratulations. Pradesh says, fake out upside and then tank. We'll take a look at, we'll do some market polls for the market as well. So towards the end of the live stream, we'll also take a look at the market expectations from all of you. Kevin says, I love the poll. These are the important questions we need to be asking. Absolutely. Gotta take some time off from betting on the markets, right? I mean, it's just constantly asking, whether the markets are going to go higher, lower, what stock's going to do what. But this is just taking a bit, of that stress off the table, simply asking the color of the tie. Yeah, you should have just had a red or a green tie to choose from. Purple to signify independence from politics. I think it's going to be purple because purple is what his kind of go-to color has been for FOMC, but we don't know what Jackson Hole is gonna be like. I think last year Jackson Hole, I think he wore a blue tie. I could be mistaken, but I think I saw some shorts from last year, or maybe he wasn't wearing a tie at all. Yeah, I should have actually put another option for no tie at all. Because it's Jackson Hole. It's supposed to be a little bit of a sort of casual weekend as they kind of go all to Wyoming. So it's also possible that he doesn't wear a tie at all, right? So that's also something that we have to consider, Kevin and everybody else. Yeah, Eric says no tie, wearing a flannel in Wyoming. That's I think what may end up happening as well, that he doesn't wear a tie at all. Anyway, so coming back over to the market, so 10-year treasuries against the Japanese 10-year bond continues to slide lower, so we're down a little bit over 1.21%. I covered this in my previous video going over the Bank of Japan and Ueda's comments in front of Parliament. This happened earlier today, just a few hours ago. So I did a video on that, and how they mentioned that the financial markets continue to be very, very unstable. And at the same time, when it comes to additional rate hike possibilities, that they're unsure whether there's going to be any more rate hikes because they're going to be examining the incoming economic data carefully and assess whether more potential rate hikes are deemed necessary. And, that's just kind of like one of the ways of Bank of Japan telling us that, look, they need to stabilize the yen. They need to somehow stop the bleeding in the yen, because if you take a look at JPY against the US dollar, it's been on a consistent slide lower. I mean, this is the overall trend for for the Japanese yen against the US dollar. Since 2012, it has practically lost a little bit over 47% of its value, so it's been cut in half in the last 11, 12 years. And this right here is the overall sell-off in the Japanese yen against the US dollar. So they need to find a way to stabilize their currency against the US dollar, because at the end of the day, one of the most important commodities in the world, which is oil, traded in US dollars, becomes very difficult for Japanese to afford as oil in yen terms continues to become more and more expensive, right? So if you take this rate, JPY USD, and divide it by the oil price, I believe that was the equation, you'll notice that it continues to slide lower. So in other words, if we invert this actual trade, or if we do oil divided by JPY USD, it continues to, of course, increase significantly, right? So that is quite a significant outperformance in oil price relative to that foreign exchange rate. So it becomes more and more expensive in yen terms, and that's one of the reasons why they want to stabilize that currency, thereby increasing their rate, and then, of course, pushing the spread lower, creating this entire environment where people sell US dollars in order to buy Japanese yen to unwind their carry trade, which also is one of the reasons why we saw the volatility in the beginning of August. Now, speaking of volatility, we're back down. Yesterday we did spike up a little bit over 7.5, almost 10% at one point during the day. Right now we're down almost 4%, back under 17. So it's going to be quite interesting to see what happens rest of the day, whether we see any comments from Jerome Powell that can spike the volatility again, or spark any type of intraday sell-off in the market, or if there's going to be a spark reversal in the markets once again. Either way, I am planning on selling puts on Nvidia, as you already know. I was listening to Dan Ives earlier. There was a 5-minute clip posted earlier today. He is very bullish on Nvidia, as we already know. He's very bullish on technology in general. And he says that this is going to be one of the most important earnings for not just Nvidia, but for the entire technology space and artificial intelligence, because Nvidia is quote unquote the godfather of AI. And whatever they guide is really where the leadership is going to come from. And where Nvidia goes is where the market follows with respect to technology and artificial intelligence. So my plan for next week, as I already mentioned, is to sell some puts, take advantage of that bullish sentiment. And the reason why I'm not doing like a straight up buying shares here is because I don't want to spend a lot of money on Nvidia at these prices, considering that the fair value for Nvidia for me personally sits in the low 100s to as much as sub $100. So I did pick up, a couple of weeks ago, going back as far as August 5th, and then I've continued to dollar cost average a little bit. So that is separate. We'll continue to buy some more shares for the long-term position that I'm building in Nvidia, but this is mostly going to be a trade. And I was also thinking more about a buy right covered call trade, but again, if there is any downward volatility, if there's any type of downside on Nvidia, that will lead to an unrealized loss with me holding on to that position, which I also don't want. So selling puts gives me a neutral to somewhat bullish bias and an overall stance where I can be more comfortable that if the stock price goes up after earnings, great. If it doesn't, if it stays flat, that's also fine. And if it drops, I've got about a 12 to 15% leeway before those puts get in the money. So that's kind of like the trade plan. And again, the yields are actually pretty strong because put premiums and call premiums both are very, very good for Nvidia. So that's what I'm planning. It's about 1%, 1.10% is the yield on just a 5-6 day basis. That's on an annualized basis, well over 50%. So those are some very, very good yields on CSPs for Nvidia. And that's the overall trade that I am looking at. So after the markets open today, my plan would be to sell another 6 or 7 puts on Nvidia. Okay. Once again, thank you so much for joining, everyone. I really appreciate it. So our goal for today is for everyone to share this live stream with friends, family members, everybody who wants to join, and definitely listen in on Jay Powell at Jackson Hole Economic Symposium. For us to get to 500 votes on our poll, so we are almost at 200 votes now, what color tie Jay Powell is going to be wearing today, and finally getting up to 82,000 subscribers. So we're just about, I think last time I checked, about 60, 70 people shy of getting up to that goal. So I would really appreciate you guys subscribing if you haven't already. That would help us get us to that goal. So I got lots of data to break down in the next 30, 40 minutes here. And again, Jay Powell is going to be talking in about an hour and 10 minutes at the Jackson Hole Economic Symposium here, reassessing the effectiveness and transmission of monetary policy. So that is the theme of this overall symposium, and which started yesterday, but this right here is going to be the agenda. So opening remarks, and that is going to be on August 23rd at 8 a.m. Wyoming time from our very own Honorable Chairman Jerome Powell. Usually, there's also going to be a PDF available of his remarks, so that's going to be available later. Then we are going to be listening in from few other professors. So we got Brown University and MIT on insights from 2020's inflation surge, which may also be very useful. It's going to be a little bit more of an academic discussion, I'm sure. Of course, may not be as market moving as what Jerome Powell is going to be talking. But then government debt in mature markets. Again, few more professors from Duke University and Stanford. Then we got general discussions and few more professors talking on financial markets and the transmission of monetary policy. And then we've also got 1 p.m. address from the governor of Bank of England, Andrew Bailey. That's actually going to be very important as well. And usually I think Christine Lagarde may also be part of this, if I'm not mistaken, from the European Central Bank. Last year I think she was part of it, but I don't see her, at least not on this agenda. But either way, Andrew Bailey and Jerome Powell, of course, two main speakers, as well as a lot of professors that are going to be part of this symposium. So that's what we have. And this right here is going to be the expectations. Well, not really expectations, but really the overall, historical analysis based on what Jay Powell, how many symposiums Jay Powell has attended, and what's the markets, how the markets have performed 1 day prior, and of course the day was the day of the symposium. So last year, of course, you witnessed about a 1.35% sell-off 1 day prior to Jay Powell speaking at the symposium, and then on the day of, about a 67 basis point increase. In 2022, it was quite brutal, 3.3% sell-off on the day, with of course a lot of individual stocks selling off quite aggressively. Then 1.4% increase 1 day prior, so a lot of volatility in 2022. 2021, 0.5% sell-off 1 day prior, and then almost a 90 basis point increase on the day of. And in 2020, we had probably the only year going back as far as the last 4 years where both the day of and the 1 day prior markets were green. In 2019, both days were red. In fact, on the day of, 2.59% sell-off, so just over 2.5%. And then 2018, 1 day prior, a little bit of a drop the day of, 62 basis points higher. So what I've really concluded from this is that if the markets do end up dropping, they drop pretty hard, anywhere from 2 to 3%, especially when Powell is talking. And if they decide to go up, they go up like by 0.5% to as much as 1%. So again, staircases up, elevators down. If they are coming down, they are going to come down pretty fast and aggressively. And if they go up, they're going to be modestly up after or during Jerome Powell's speech. So that is what we have on the agenda. Volatility is at 17.5, I think a little bit lower now. MoneyVest Index trades at 3.84 on the 49th percentile on the VIX. And again, 71% of stocks trading above their 50-day moving average, 74% stocks trading above their 200-day moving average. So this has been actually quite a broad rally for the market, because what has recently hit a new all-time high? I really want to know if anybody can identify and understand what actually hit a new all-time high. Let's see. This is a quiz for all of you, which I haven't really covered in our market updates. So as we know, S&P 500 did not hit a new all-time high, right? It got up to within 1% of its striking distance of all-time highs, and then of course yesterday's sell-off. But what is one index that actually hit a new all-time high? So this right here, we were off by 1% on the all-time high at one point, just over 0.5%, but then of course we sold it back down. But what hit a new all-time high? So a lot of people saying gold, which is true. Gold did hit a new all-time high. So that is one of the many indices that hit a new all-time high. Orange juice is very close. Didn't quite getting up to all-time high. But no, Palantir did not hit a new all-time high. But there's one indicator that can tell us a lot about the overall market structure and a little bit more about here's a hint, market breadth. So let's see now if you can get a little bit of a sense. And I haven't checked this, but I'm pretty sure it has hit a new all-time high because I was reading about this the other day, but I haven't checked it for it myself. So it'd be pretty embarrassing if it didn't hit a new all-time high. So let me just check here very quickly, but I'm going to wait for a few more people to participate in the chat and let us know what you think has already hit a new all-time high in terms of the market breadth, and the overall structure. And again, here's another hint, market participation. Milan says VIX, no way. I mean, volatility, this is the third largest increase since since overall, and the highest level since the pandemic, but we have been much, much higher on the volatility. Okay, it is the equal weight S&P 500. So Sir Lutalot, that's quite an interesting name. You're right. It's the S&P 500 equal weight, which is going to be tracked by RSP. If you come over to this particular ETF, you'll notice that yesterday we actually hit a new all-time high at over $1,173, and we're already up 68 basis points, hitting a new all-time high for this particular index or ETF right now that we're looking at. So this is the equal weighted S&P 500 ETF, and the way it works is basically every single 500 company is given equal weighting, and what this really tells us is how broad this participation has been from the market, right, in terms of this recovery. So the technology sector, which was kind of lagging behind, which was kind of like the leadership, right? That was the leaders behind this entire market rally. Then again, August 5th happened. We saw a significant sell-off, tech sector pretty much in a bear market, down over 20%. Then we had a recovery. But we haven't seen a few of those companies have been kind of lagging behind. And those companies are like Google, Microsoft. They're actually underperforming the S&P 500. And other sectors have picked up. That's exactly why we've actually seen over 70% of the S&P 500 back above their 50 and 200 simple moving average because of the broader participation. And as a result, the RSP ETF, so Wealther PPK, it's not an indicator, it's an ETF. You can actually trade it, you can invest in it. So RSP is just the S&P 500 equal weighted ETF, which is hitting a new all-time high. It goes to show that there's been a broad participation in overall more companies, more other sectors that have been rallying higher. And this, again, goes back to the discussion of how defensive the markets have been, right? The markets have overall been a bit more defensive ever since the carry trade begun unwinding, for reasons being because of the increased volatility, because of the fear in the markets and how long or how big this sell-off is going to be. And as a result, people moved into defensive names, right? So utilities, real estate, even staples, defensive stocks, they tend to actually do well in that environment. And as a result, we've seen that outperformance from defensive against technology. So that's why this indicator definitely pushing higher. And this is the overall chart that I shared in my yesterday's video. But you use it as a like indicator? Yeah. So, I mean, it gives us a bit of an idea of how other parts of the market are doing because it's not market cap weighted, right? So says, can we stop calling it a carry trade? It's really not. I mean, what is it then? If you care to elaborate. We're only calling it because, I mean, that's what it ended up being, because you're borrowing money in Japan in yen very, very cheaply, and then buying US dollars and then investing in US dollar denominated assets, and then trying to unwind that trade as the USD starts to depreciate against the Japanese yen as interest rates, the spread, of course, comes down. Anyway, so this right here is the 500 companies in the S&P 500, and I'm tracking them on a regular basis. And what this does is, of course, looks at all the companies, the market cap, and then it tracks the previous close, the current price. So let me just put that in. This is the previous closing price. This is the market price, and this is the percentage change. This is the current market cap, and this is the dollar change. And yesterday, what we really witnessed was $435 billion loss in the S&P 500. So yesterday's sell-off resulted in $435 billion loss collectively. And the majority of that came from big tech, right? Because if you take a look at, again, this is a quick way to really identify and filter out some of those things. So if you just do, let's see, greater than 0. So if you take a look at the companies that actually benefited from it, Berkshire Hathaway, almost at $1 trillion in valuation, was up yesterday. Eli Lilly, JP Morgan, ExxonMobil, United Health, MasterCard, Johnson & Johnson, Merck, Walmart, Chevron, Bank of America. So you can kind of get a sense of which companies actually moved higher. And again, you can look at it on a heat map as well. I'm just looking at it on a spreadsheet right now. But you've got financials, you've got healthcare, you've got energy, you've got utilities like PepsiCo's on there, Abbott Laboratories, Intuitive Surgical, Philip Morris, Altria, Raytheon. So all these companies pushing higher, gaining market cap, right, yesterday, as opposed to the Magnificent Seven, which lost over 326 billion. So $326 billion loss off of 420 billion. So we're really looking at over 78%, 77% of the loss coming in technology, right? So entire yesterday's sell-off was very, very tech concentrated. And as a result, RSP doing much better because it's equal weighted. It doesn't put so much weight on technology. Other sectors moving higher, technology selling off, and thereby the S&P 500 is kind of having a hard time pushing up because of the lack of the momentum from technology. So that was something to keep in mind. Of course, we did have a risk on trade, then we became risk off, then we became risk on again, but we're not fully risk on because there's been some laggards even within Magnificent Seven. I mean, Amazon, Google, Microsoft, they're still significantly down. So if you come over to our website, you'll notice that Apple still well within a pullback, Amazon still in a correction, Microsoft still in a correction, Nvidia still in a correction, Google still in a correction, Broadcom still in a correction, and these are all down over 10, 12, 13% from their all-time highs. Tesla very close to a crash. It is still in a bear market, down over 49%. Then you got AMD in a bear market, down over 33%, Qualcomm in a bear market, Adobe in a bear market, Salesforce in a correction, Oracle in a pullback. The only stock that's kind of held up really well is Meta. Meta is the only company that's held up really well. I mean, Meta only down 2%. It's in a bit of a dip. And even Netflix, hitting new all-time highs very recently, getting up to over $700, is only down 3% from its all-time highs. It's still well within 5% of its all-time highs. So still in a bit of a dip. So those are the only two among the FANG or the Magnificent Seven that have kind of held up. Everything else is still in a correction or a bit of a dip. Okay, coming back over to the markets. And yes, waiting for Nvidia earnings. Nvidia earnings are going to be very, very important for the market, and it's really what I'm planning my trade on for the next week. Kajal and Raj, hi, Mr. Genius. Please don't call me that. I'm not a genius at all. Hope you're well. Can I ask if NVDL, putting aside price, is okay to hold for 1 to 2 years? Does having leverage ETF have any downside other than bigger percentage drawdowns in the P&L? So yes and no. So if you really just look at it from the perspective of buy and hold, leverage ETFs are really not the best ways to construct a buy and hold because there's a lot of fees involved and there's also a lot of decay. The only thing that you really want to make sure, there's actually a couple things. Number one is the drawdown. Right, the drawdown can be quite catastrophic for leveraged products. They're really only meant for trading purposes and not from a buy and hold perspective. So, if you're ever trading SOXL or TQQQ or FNGU or any of the leverage ETFs that we've discussed on the channel, for me, they've never really been sort of buy and hold forever. Reason being is because they can go through significant amount of volatility. So if you're okay with that level of volatility being down 60, 70, 80%, and you got that in you to keep plowing money into that ETF, dollar cost average down, then by all means, this is something that you may look into. But not a lot of people can do that. And even if you think that you can do that, in the moment, it is going to be the most difficult thing to ever do because, it's not, and this is something that's discussed in our Psychology of Investing course, is it's easy to say that, oh yeah, Nvidia, if it's down 80%, I'm going to buy it. If it's down 80%, that's going to be a huge deal. I'll be a buyer at that price. But most often than not, it's a very, very difficult decision to make, especially if you are in that company, in that stock, and you're down 80% from all-time highs. So it becomes very difficult. So it's not until you actually experience it that you're able to really feel what it's like to be in that position. So since you are not in that position right now, you can make a decision. Right, your mind can make a decision that, yeah, that's fine. I mean, I can handle that 60% volatility. I mean, for example, Nvidia was down, 30%? NVDL ended up being down over 62% from its all-time highs during this entire sell-off that we just witnessed over the last couple of weeks. So it's kind of easy to say that, yeah, I mean, I would have bought at a 62% sell-off, but it's not until you actually are in that situation or in that position to understand that. And then again, in terms of that decay factor playing in, these are constructed on a basis of daily returns. So daily percentage moves. So even if Nvidia, recovers back to all-time highs, there's no guarantees that this is going to recover back to all-time highs because of the decay factor. And over time, if Nvidia continues to stay flat, this ETF is going to continue to decay and lose value. So those are some things to consider. That's why they're not meant to be held long-term, and only from a trading perspective make for very good products or instruments that you can use to trade. So for me personally, when I'm looking at leveraged ETFs, I'm only looking at a day to as much as a few weeks, or even a few months is okay, considering on some technical analysis and based on your risk profile and what you're looking to get out of that trade. But getting up to over a year, anything can really happen in a year. If you really just track the overall volatility of a stock, I mean, for example, Nvidia that you mentioned, beta is really high. Nvidia's beta is, we can actually track that on our platform. So if you come over, I think we have that. So if you come over here, so Nvidia has got look at that. So Nvidia has a beta of 2.78. That is a really, really high beta, right? So it's just comparison against the S&P 500's volatility. So that just goes to show how volatile that stock can be. So, when you're trading a stock that has such a high beta and again, very, very high levels of volatility, you're really just opening yourself up to significant amount of potential risk, especially if you tag on the leverage factor on top of that. So yeah, I mean, QQQ's SPY are still reasonable products to trade leverage ETFs on because, again, their volatility is significantly lower compared to that of Nvidia or Tesla. So yeah, those I prefer. You can kind of extend the timelines on those as opposed to something that's as volatile as Nvidia or Tesla. Okay, Mohit says, I think they are now buying more USD opposed to JPY though, so it's a different dynamic as JPY will appreciate heavily. Yeah, so I mean, Japanese yen, it's possible that it starts appreciating a little bit further against the US dollar. So I do think actually that they might be, again, the unwinding of the carry trade is forcing a lot of traders, investors who borrowed in JPY and then bought USD to then now sell USD to once again convert back into JPY as their loans come due, as they get those margin calls to start fulfilling those margin calls. They have to get out of those trades. And that's exactly what created this entire dynamic of selling pressure, selling US dollar, and then buying into JPY. So no rate hike now from BOJ. So we don't know for sure, but just from the comments from Ueda earlier this morning, which again was evening in Japan, they mentioned that they're going to be examining more economic data, incoming economic data, to better assess whether more rate hikes are necessary or not. But at the moment, obviously they mentioned the financial markets are very unstable, and they're going to continue to see a slow and gradual process of monetary easing is what they mentioned. So what I take from that overall, segment is that they are going to be data dependent, just like the Fed, but they're also trying to achieve a specific goal, right? They obviously don't care as much about the United States monetary policy as they do about their own policy, right? So they're going to do what's best for their country, right? That is stabilizing the yen, making sure that their people have affordable prices within the country. And one of the most important things is oil, right? Oil being the most traded and most important commodity in the world. As I mentioned earlier, it's becoming more expensive for them to import oil as they are a net importer of that commodity. And again, it's traded in US dollars. So if their currency continues to depreciate, it becomes more expensive, thereby putting more pressure on the consumers within Japan, and again, increasing prices significantly. So in order to control that, they have to stabilize their currency, and they do that by raising interest rates. So in my opinion, I think, yes, they have to be a little bit more, careful about not shocking the markets or surprising the markets, because Nikkei also did drop significantly. It had one of the worst days since 1987. So in my opinion, I think we could still see maybe another 25 basis point towards the end of the year, maybe November, December. Again, we'll find out. But yeah, so they're kind of like in their own world, because they're moving separate from all the other central banks in the world, as all these central banks are kind of looking to cut rates. Some of them have already begun. Bank of England, ECB, and Jerome Powell to start very soon in September. They are now on the path of increasing interest rates. So that's what's causing that spread to continue to come down, thereby putting pressure on US dollar and US dollar denominated assets. Okay. Vault, Caddy, will you be selling some of your positions to raise cash, or the cash positions you mentioned in recent videos is going to be built from external sources? So mostly from external sources, putting more of my savings into my brokerages, and also selling puts and calls. So selling options, that's what I will be doing. And as a result, we'll be raising more cash to get ready for September. September is the month, which historically has been, of course, not that great. And I really want to know, like, what is your thoughts? What is everybody thinking for September this year? Because, we're August 23rd now, so we're less than 2 weeks away from September to start. The last 4 Septembers have been pretty brutal. So I really want to know what everybody's thinking in the community. Are you expecting another September sell-off, or for the markets to just rip and ignore the September seasonality? Now, one thing I will mention is that in the last 12 years, September, when it was green, we were green by an average of 1.89%. But every time that it was red, we were down by a whopping 4.3%. So when the month of September is red, we are down on average 4.3%. But when it's green, we're up just about 1.8%. So there's definitely a much bigger sell-off than a gain in the month of September. But another thing to really note here is the volatility. The VIX usually has been higher, and this is the VIX high price. So what's the highest level that it got up to in the month of September? And this is going back as far as, like I said, 2011. So what you'll notice is last year, the high volatility reading was 19.71. 34.88, so just under 35 in 2022, a little bit over 28 in 2021, over 30 again in 2020, and then it's been a little bit lower readings, and then 2015 was once again over 33, and then going back as far as 2011, we were well over 43. So we are going to be expecting from Powell at 10 a.m. Eastern. So 10 a.m. Eastern is when he's going to be talking at the Jackson Hole Economic Symposium. So this right here is the volatility reading. And one more thing I want to point out is 2018, you may feel like volatility was lower at 15.63, but in October, it actually spiked 75%. So September was low, but October, we ended up spiking over 75%. And another thing that I've noticed is that while September is a brutal month, October has actually been the month where most bottoms have occurred in the last 5 years. So that's also a piece of data that I think is quite interesting, that October usually is the month that ends up being the bottom for the market in most of the years that we've witnessed over the last 5 years. September month is brutal, but October tends to form a bottom in the market and then starts to rip back higher because of the continuation from the September selling pressure. And then October kind of things stabilize a little bit. People start buying stocks up again. And then we start to see that rally in the fourth quarter, especially kind of going into November and December, which is the holiday season where earnings are going to be expected to be very high with spending at an all-time high as well. So that is the overall historical data point for volatility and, of course, for the month of September. Okay, so 15 minutes left for the markets to open here. And we've got QQQs up a little bit over 1%, so nice little rebound. Tesla is up over 1.4. Nvidia is up over 1.6. I really don't want Nvidia back over 125 right now. I really want it sub 120 so I can sell some more puts and then it can start going higher. Microsoft is up over 76 basis points and S&P 500 up just over 65 basis points at the moment. So we're at 382 votes, everyone. So let's see if we can get up to 500. We also should have put a no tie as a potential option because I'm starting to feel that he's not going to be wearing any tie at this Jackson Hole Economic Symposium. But nonetheless, do pick a color, what you believe or what you expect. Also, make sure that you drop a like, everyone. I would really appreciate that. And share this live stream with other people. We're trying to get to 82,000 subscribers. We're very close. I really am grateful for each and every one of you. Nothing would be possible without all of you. So I really appreciate that. And let's take a look at PayPal as well. PayPal here on the day getting up to as much as 72.17. So up almost 1%. On the day after having a nice little breakout on some decent volume. And the next big threshold that it needs to break out of is going to be $77. I really want to focus on Tesla today because Tesla seems to be getting a lot of selling pressure. Yesterday, down over 5.6%. I should have really, covered or did a video or do a video on Tesla yesterday. But this right here is the support at $208 a share for Tesla. Just a few things that I'm going to take a note of here. I also have Twitter X open. You guys can connect with me there. So, okay, let's take a look at what time is he speaking again? 10 a.m. Eastern is the point when he's talking. Christian, to the same point, do you think 5% of the positions that sit above 50% gains in order to raise cash is a good strategy so that I get rid of 10-15% of the portfolio, no cash to add external? So that's a good question, and it's kind of difficult if you have no way to add more money to the portfolio, right? Ideally, where you want to be in a position is that your portfolio grows, right, as you are making investing decisions and you're picking stocks and your stocks are doing well, and then you're also adding more, right, every month, whether it's from your savings or your income or your job or whatever it is that you do. You're adding more money, so that way you're getting a double benefit, right? So you can have that to buy more stocks, and those stocks go up, and then again keep adding, keep compounding, and that's one of the best ways to do it. And then if you don't have any additional external cash to add, I think selling options is a good way on companies that you're already up on. So if you're up 50, 60, 70%, if you want to raise capital, then selling calls on them could be a good potential idea. But then you also have to take into account the possibility of getting those shares called away and then thereby triggering a sale, and then your tax consequences, and at the same time if you're comfortable selling those shares in the first place. Because if you have a long-term view on any company and you don't want to sell that stock or don't want to get rid of it, then selling calls is not something that you would want to look into, unless you're selling way out of the money calls that are practically going to be worthless in the beginning. They're not going to pay you any premium, but it's still free money at the end of the day. So, but it's not going to make a huge dent. So those are some things to consider. If you are okay with trimming those positions, if that's part of your plan, then selling calls can be a potential strategy to generate some additional cash flow. Especially when you're looking at some of these companies like Tesla, Nvidia. If you own a lot of these tech companies, their volatility is very high, and as a result, premiums are very, very strong. I mean, I remember Nvidia pre-split basis, premiums were insane, like absolutely insane, like $5,000-$10,000 if you've got a couple hundred shares, was quite crazy. But then, of course, it was also trading at almost $1,000, right? So again, as volatile as a company is, and as significant the intraday movements, that's how the premiums are priced, and that can generate a pretty good cash flow on a long-term basis. That's the whole idea. That's what I'm going to be planning to do moving forward, weekly puts or weekly calls, and we'll update everybody in Discord the options portfolio. So yeah, Caddy, sorry to post it one more time, but how does decay work for leverage ETFs? How does the function look like based on what permanent decays function here thing? So basically, when you're looking at ETFs, they are not actually holding any stock, right? There's no underlying stock in that particular leveraged ETF. What they're really doing is they're constructed based on options or futures of that particular stock. And as you know, that options futures, they have the time value of money built in, and as time goes on, the value of the option is going to erode, and as a result, that's the decay. So even if the price doesn't move, the value of the option is going to continue to go down, right? So that is the decaying factor for that. And there's also fees involved with trading options or futures. So there's always an expense built into that leveraged ETF. So that's why, leveraged ETFs are great from a trading perspective, because if the stock price goes down or doesn't do anything, so basically there's three things any company or any stock can do, right? It can go up, it can go down, or it can stay flat, right? Those are the three things. What I like to do is I like to sell options, because that gives me the benefit, or a stance, you can say, of two out of those three things. If you're buying a call, you want the price to go up, right? You don't want the price to stay flat. You don't want the price to go down. If you're buying a call, you want the price to go up. You can't make money if the price stays flat, so it doesn't get in the money ever, or if it goes down, it goes farther out of the money. If I'm selling a call, right, if the price goes down, that's great for me. If it stays flat, that's also great for me, right? And even if it goes up, that is also okay if you structure that trade in a way where you're comfortable, getting rid of that stock in the first place. And if it gets in the money, that's fine. I mean, you're still going to have that capital gain plus the premium that you received. So you really want to give yourself a position where you're comfortable with the neutrality of the direction for those trades, because that's why buying calls and puts has almost always been one of the low probability trading setups, because you have to be right on the direction, you have to be right on the timing, and you have to be right on the pricing. And you can be right on all three, at least not consistently over time. So that's why selling options has been far more successful and a better strategy. Yes, it yields a lower profit, but it also is a higher probability outcome. So that's what I prefer to do. And of course, if you've got a bigger base, then you can do it more consistently and you don't need to reach out more for a higher yield and take on too much risk. You can be a little bit more conservative and still generate some good income on a weekly, monthly, yearly basis. I mean, a lot of people do it in our community. They've been doing it for many years. And so that's why it's a more patient, right? It requires a lot of patience. It requires a lot of decent analysis, right? There's not any aspect of gambling into it, but there's also some very simple things that you can look at to better structure those option trades. Okay, Christian says, thanks a lot for the answer. Unfortunately, I sit in Romania and options trading is almost impossible. Yeah, I mean, I've been there. That's got to be frustrating. So, yeah, I understand that options trading is not a possibility for everyone, and so there's going to be different circumstances. So that's why, again, you have to look at other options on how to trade, how to invest, because it is what it is, right? So I mean, even in India, I think option trading at least for U.S. equities is not possible. For Indian equities, it is. Futures and options possible within Indian equities, but again, I think U.S. options are not possible. Okay, anyway, so we got Fed Chair Jerome Powell talking in just over 30 minutes, everyone. Thank you so much for joining in for this live stream. We got market open in about 7 minutes now. Make sure that you drop a like, subscribe to the channel, and share this live stream in your WhatsApp groups, Facebook, Discord, Telegram, whatever it is they use. Get more people to join so we can have a better engagement for when Jay Powell starts talking in just over 30 minutes. Markets are pushing higher, so QQQ is up just a little bit over 90 basis points, so just under 1%, with the S&P 500 also up over 60 basis points right now. So that's where we are. I'll take a look at some of those comments. So Tesla we'll take a look at in just a minute. CRM, Jenny, we can also check out. But, a lot of the stocks, if you just go to our platform, they're going to be available for you to analyze. You can come over to the market snapshot, or you can simply search for individual stocks up top. And then do a full comprehensive analysis. Like CRM, for example, you asked 3.85 M score. That is a numerical value that we've assigned for almost every company out there. And that's a pretty good M score. And again, you can come over to MoneyVest metrics, start to plot for different things like revenue for the last 7 years for the company. You can look at operating income, gross profit. Everything's going to be available on the platform. So that is going to be available with fundamental analysis also available here. So there we go. 20 years worth of analysis. You can do all of that. So here we go. Revenue, gross profit, operating income. So all that stuff available. You can do full blown analysis here with the discounted earnings model, discounted cash flow model to better understand whether it's undervalued, overvalued, fairly valued. So most of the work is done already with our predetermined numbers and metrics. You simply have to spend 5, 10 minutes, 12 minutes, 15 minutes to quickly take a look at, how well the company is doing. And then of course you can engage and ask questions in our community as well. So that's the reason why we have built this, right? Platform is for everyone and making it accessible to everyone to do that analysis. Wealth through PPK asking, can I borrow $13,000 from you to invest? So I need to ask 3 questions. Number 1, what is your credit score? I want to know how worthy you are as a borrower. Number 2, what interest rate? And number 3, what are you going to be investing it in? So those are the 3 questions. If you can answer those 3 questions, maybe I'll think about it. So compared to Dubai, is Indian tax rate higher? Yes, significantly higher, because Dubai, there's no personal income or capital gains tax. They just recently introduced a corporate tax last year of 9%. So yes, it's much higher. So can you trade options from Dubai? Yes. There's not been any restrictions, not that I know of, for trading options. All in FNGU, 0% rate and 0 credit score. Love it, love it, love it, love it. That's a perfect YOLO trade right there. Anyway, so coming back over to Tesla, we got a support level of $208. So that's the level that we're really paying attention to here on the day. And if it does end up, let's say, breaking down, which would not be unlikely, then the next support is going to be down here inside this green rectangle, sitting roughly at 183, 184. Okay, so in the 730s, that's a pretty good rate. 0.1%, and into VOO, S&P 500. So you want to have a carry trade with me. You just want to borrow cheaply from me and then invest it in VOO to get that rate differential. Wow. Okay. So 0.1%, obviously, even if you are a lender, even if you are a personal lender, always think of money as a product, right? Don't think of money as money. Always think of money as a product, and all of us have it. So if you are ever thinking about lending it, definitely do ask, what's the interest rate that you're going to get. So even if you're thinking about buying bonds, everything really ends up being a conversation around interest rates. What is the interest that you are getting? What is the interest that you're paying? How much can you expect to earn? And always remember, the interest on your debt is fixed. The interest on your asset is always going to be uncertain. Unless, of course, you're buying bonds. So if you're putting it into the market, if you're putting it in dividend stocks, if you're putting it into real estate, if you're putting it into Bitcoin, if you're putting it into gold, none of those interest rates are ever guaranteed, right? Even with the US, if you're buying bonds, that interest rate is backed by the US government, but even that has a very small probability of not being guaranteed. It's about almost 99% guaranteed because it's backed by the full faith and credit of the United States. But again, there's always a small probability that it's not. So the interest rate that you earn or are you expected to earn is always going to be uncertain, but the interest rate that you are paying on your debt is always going to be fixed. And that's just how the banks and the structure works with regards to just financing in general. Okay, yes, 500 votes, everyone. Thank you so much. We're going to end this poll now. 30% for red and blue, 20% for purple, and 20% for black. We are going to end this poll and then start a new one. We've got also 500 people watching, so thank you so much, everyone, for joining us. I really appreciate that. Make sure you drop a like and subscribe. And I'm also going to share where we are very quickly on the subscriber count because we're trying to get to 82,000. Market's going to open in about a minute 10. And let's take a quick look here. So make sure that you subscribe if you haven't already. We right now are sitting at 81,927. So 927 is where we are at. So make sure that you do subscribe if you haven't already. Really help us get closer to that goal. And we are ready in about a minute for markets to open. And then Jay Powell is going to be talking in about 30 minutes. 30 minutes is Jay Powell speech begins. Maya says, man, I'm doing squats right now, watching the live and watching the market. That's incredible. That's dedication right there. Working out and also trading at the same time. So Wasim, what if you invest in Dubai and move to another country? Do you have to pay capital gains tax? So invest in Dubai, like what do you mean? Like invest in real estate or invest in what in Dubai if you invest in? Okay, so markets are open. We got the S&P 500, 60 basis points higher. QQQs are also green, almost 90 basis points. Then we've got Nvidia up over 1.7%. I really don't want to see that because I actually want to see Nvidia a little bit lower today. So the moment it turns red, I will be interested in selling some puts again, the ones that I'm waiting for, and we'll send out the alerts. We'll also take a look at the premiums for those puts on Nvidia. Wall says, Caddy, with such an increase in subscribers, you should probably start working on a 100K special episode. It's going to take some time for us to get there. Our goal is to get there by the end of this year. So hopefully, fingers crossed, we get to that target. Did anybody see that Ronaldo finally joined YouTube and hit 30 million subscribers within 24 hours? Oh man, over here, I'm busting my ass to get 200,000. Okay, so the puts for next week on Nvidia, the ones that we sold at 105 are now at 109. So there's not a lot of returns on those. I'm also looking at $104 puts, 97 cents. I'll wait for those prices to increase just a little bit because of So I'll take a look at those 97 cents right now, 104. I really want to get to 125, like $1.25, and I am at $104 put strike for next week. I think that would be pretty decent, just over 1.1% yield on a weekly basis. So we are seeing some red candles pop in ahead of Jay Powell. Okay, let's do one more poll right now. We're going to do for everyone. So today's poll is going to be markets today let's just do markets today. Very green, red, or very red. Let's do this. And we're talking very green as in over 1%. And very red to be over 1% down, and green and red to be well within plus minus 1% for the day. So far we are green. QQQs are up over 73 basis points. S&P also up about 0.5%. And then we got Nvidia also pushing higher 1.5%. And like I said, I really want this to be a little bit lower so that we can take that trade that we're looking for next week. Again, 30 minutes, less than 30 minutes for Jay Powell to start talking at Jackson Hole. And we'll do a quick audio check because last time I think there were some errors, but we'll do an audio check and then we should be all set with Powell's speech and the market's reaction. Some pretty big red candles coming in right at the open. But we're still green. I don't expect for the markets to just switch to red before Jay Powell starts talking, but you just never know. Yes, Milan, I'll be live for Jackson Hole, of course. What's your take on Airbnb? Do you think it's cheap? So from a cheap perspective, I think we've done some analysis on Airbnb. I mentioned that it's one of my favorite companies. I've used it many times in the past. Every time I've traveled, I've pretty much used Airbnbs. And I do like that company. I think from a business standpoint, from what they have to offer, it's one of the best. But from a fundamental standpoint, I think I'll have to revisit and see what the valuation looks like and how well or worse the company is positioned in terms of pricing. But overall business, yes. And I have done analysis on Airbnb in the past. So if you do search simply MoneyVest Airbnb analysis, you should get a couple videos that we have posted in the last year for that stock. Okay, coming over to Magnificent 7. We've got everything green. Tesla rebounding well, up over 2.4%. Nvidia's up 1.5%. AMD's up 1.3%. We got Google, Meta pushing up about 0.5% each. Apple, Netflix, Amazon, Microsoft all pushing higher, up about 40-50 basis points. And again, we'll keep a close eye on all of these. I'm also going to be looking at my phone here because I am thinking about selling puts on Nvidia before it starts to take off here. $110 puts are now selling for $1.64 for Nvidia here. And yeah, So not bad, not bad. But we'll see. I mean, we'll see what type of drawdown that's going to look like for Nvidia from 126 down to 110. I believe that's going to be just over 11%, 12%, just a little bit over 12.7%. And I think going into next week, the expectations are for plus minus 10% for Nvidia in terms of earnings, which they are reporting on Wednesday. So I think even 110 may work. But I actually sold that for 105 yesterday, just one of the 6 that I'm planning to sell. So 110. Again, I'll wait. I'll wait for the next 25 minutes, see what Jay Powell says, how the markets react. It would be ideal if the markets actually do pull back and we get that opportunity. But if it does rip higher, that's also okay. No worries there. For how long is that trade for puts? Just for the next Friday. Next Friday expiration, so just about 1 week. Just about 1 week. Tom Lee suggesting IWM 270, 280 plus for IWM. Yes, so I think it was like over $300. I think he put an estimate out to $300 for IWM. My thoughts are aligned with his. I don't expect as much upside as he does, but it's kind of aligned with what he's thinking about small caps, because interest rate cuts is going to be a very significant tailwind for small caps. So I do believe that small caps have a ton of potential. That's why I've been buying IWM as well. It's part of our holdings. So IWM, and people have been trading TNA, which is the leveraged ETF, against IWM. But again, be careful because it's leveraged. So there's a significant factor of decay and it can be very volatile. So what are you expecting Nvidia price to be before earnings? My guess is 140. So I can tell you So I can tell you, I can't tell you where I'm expecting Nvidia price to be after earnings, but I can tell you where I'm expecting it to not be after earnings, and that is not be at 110 or lower. So that's the trade that I'm taking, that it's not going to be below 110, or ideally below 105 post earnings. If it is, then that's also okay. It's not the worst thing in the world, but that's where I'm not expecting for Nvidia to be post earnings. Where is it going to be? That is a whole different question, built around whether they beat expectations, and I think guidance is going to be a much bigger factor around Nvidia. So, man, Nvidia is really running here, huh? Milan says, "Don't jinx it." I'm not jinxing anything. I'm just saying that's where I expected to not be at 110 or 105. But then you never know. We could be having this conversation 1 week later. Today's Friday. Next Friday, we could be looking at Nvidia at $90. Anything is possible in the markets, right? Jeremy West, thanks for the deep red video yesterday. Great insight. So yes, I highly recommend everyone checking out that video because, as we've had a lot of new people join, new subscribers have come in. I've been getting a lot of questions on individual stocks. They might be down anywhere from 50 to 70 to 80%. So I think it's really important to watch that, understand when it comes to individual stocks and investing in individual stocks, they do need, constant evaluation. You need to revisit the story, revisit the numbers, see how those companies are doing in order to continue to ask yourself questions of whether it still deserves a place in your portfolio, whether you still deserve to put in your hard-earned money into that company or not. Because if you let those companies go, right, in your portfolio, and then you check back in a week later, a month later, a year later, and they're down 50%, 70%, then you've kind of created this unsalvageable position for yourself. There's no way getting out of that, right? Unless the stock rips 300, 500%, which is a very unlikely outcome. So it's really important to stay on top of them. If you are going to invest in individual stocks, do it the right way, be more active. I've made the same mistake, right? And that's what I've learned over the years, is that you just can't, regardless of how great you think the company is, you just can't just buy and hold forever. Because companies, just like human beings, they have their phase where they grow, they mature, and then they decay. That's just how these cycles work. And no company is ever going to be immune to all market environments. There's going to be environments, circumstances where, specific companies that you thought were absolutely the best companies in the world, not do well, right? So Nvidia, I bring up Nvidia as one of the examples almost always, is that just because we think that Nvidia is the hottest stock in the market today, may not be the case in 2032 or 2034 or 2035, like 10 years from now or 15 years from now. It could be something else, right? So markets are evolving, technology continues to evolve, and understanding those factors, I think it's really important to stay on top of them. Be more active. If you are going to be actively investing in individual stocks, be active and be proactive to understand their story and their numbers. So Occidental Petroleum, I think it's great for value and dividend investors. I think it's a stock that is worth looking into if you are mostly invested in good dividend yields. It's a company that's improved its situation over the years because they've paid down debt significantly. If you come over to, man, I tell you, my laptop's really been breaking down on me over the last couple weeks here. I don't know why, because Apple is announcing new products soon, so I don't know what's going on, but my MacBook definitely is freezing, hanging, and just really, really slow. Very frustrating. But anyway, if you come over to the quarterly numbers for, Occidental, and if you take a look at, let's see, the balance sheet here, you take a look at this. I mean, they have been coming down consistently, and then if you come take a look at total debt for the company, especially the long-term debt, it's been significant pay down from 30 billion down to 18.3 billion. And then if you plug in free cash flow all the way at the bottom here, you'll notice that they've actually been pretty stable. More recently have come down, but there was a time in 2022, 2023, they were generating well over $1.5 billion in free cash flow every quarter. So those were, I think, some of the reasons why Warren Buffett was really excited about them, and he's actually been a long time investor in Occidental. I did a couple videos on this already, and it's a good sort of value/dividend stock. It does pay a pretty decent dividend yield of 2.67%, and we've got 11 times price earnings multiple, right? So it's got a potential as a value/dividend trade. Okay, I don't know what's going on here. So Lokesh says, wow, I'm joining this channel after a long today, and last time I visited it, Caddy advised me to buy VRTX, Vertex Pharmaceutical, absolutely incredible company in biotech, treating cystic fibrosis. It's done really, really well over the years. In fact, Vertex was one of those companies that protected me in 2022. 2022 was brutal for technology, but Vertex actually outperformed in 2022. So if you come take a look at VRTX, but Lokesh, man, you're joining us after a long time. I feel like a couple of years maybe now. But this right here was Vertex Pharmaceutical. And yes, in 2022, trading down to low 200s, and was one of the companies that was selling off quite aggressively in 2021. See what I'm talking about? It's taking so long to load these charts. But this right here has been the weekly time frame for Vertex, and since 2022, quite literally since the beginning of 2022, it is up a little bit over 170%. So very, very nice gains. So Kumar, if I'm just trying to pocket the premium, why not sell puts on NVDL? Well, for a couple of reasons. I doubt NVDL is going to be that liquid in terms of options. So if I simply take a look and pull it up on my Webull, so come over to options and we take a look. So 7 days. So open interest is actually decent for next week, not bad. And then if I come down for some of the lower priced options with lower deltas, I guess one could trade NVDL as well. I guess there's no reason as to why you can't, but just be careful because of the increased volatility of a post-earnings move. Because if Nvidia is down like 10%, NVDL could be down 20%, so you have to obviously account for that, and then look at what strikes to really pick for in that scenario. So you've got a great point. I think NVDL also is a potential option for trading options. John S. Creatures, thank you so much for the donation. I really appreciate that. Big favor from you, my friend. When do you know it's time to get out of a position in stocks? Okay, I mean, we can spend a lot of time on this question because there is a lot of things to really unpack in that question. But but let me ask you this, like, are you up or down on that stock? Like, are you trying to get rid of it because you're down and you're done with it? Or are you trying to decide whether it's time to take profit? Because then, again, that is going to tailor that question a little bit differently, or the answer a little bit differently, as to when you should really think about getting rid of a position. So from a long-term perspective, right? If you're buying a stock and you're up on it, and from a long-term perspective, you really don't want to sell your winners, right? You really don't want to sell your winners, and you don't want to continue to double down on a loser. Now, what constitutes a winner and a loser really depends on your conviction and analysis of that company. Now, your analysis comes from understanding the story and the numbers, right? Story being the qualitative analysis of the business, numbers being the quantitative analysis. So once you combine those two things, you make an investment thesis around that company, right? Could be any company, could be any stock, could be any investment. So whatever you analyze, and if the market agrees, that's when you're going to see that capital appreciation. You're going to see that investment turn into a profitable one. Now, if you decide to, let's say, sell, the same process has to be applied, right? If you continue to have that conviction in that company, if you continue to believe that, okay, it's still got a ton of potential and it's only gotten better, the story's only gotten better, numbers have only gotten better, there's no reason to sell your winners. There's no reason to get rid of them. If anything, you can think about doubling down on it if you believe that is going to continue. So I think the worst thing investors can do is sell their winning stocks too early, not allowing it to compound over many years. Because the thing is that, Amazon is a prime example of how it sold off over 80% during the dot-com bubble, and then ended up ripping thousands of percentages from those levels. Now, there's a lot of things that we can draw, right? A lot of psychological pitfalls that we can draw from that entire case study. Investors originally who were in euphoria bought at the very top, right? Because they thought that stock's going to keep going up because they didn't have any understanding of the fundamentals, didn't really understand the story or the numbers or anything like that. Ended up, down underwater over 80% on that stock. Then there's investors who sold at the very bottom, thinking that it's going to keep going down and it's not going to recover ever. It's done. It's going to be a company that's going to go under. So they never participated and sold for a huge loss. Then there's investors who bought at the very bottom, right? Took advantage, but then maybe sold too early after 100%, 200% recovery, and didn't have the time or the patience to hold it on all the way to where it is now, a multiple trillion-dollar company. So there's a lot of things that you can kind of draw from that entire run-up, then a crash, then a run-up again, and then a long-term thousands of percentage of increase. So again, it's a great question. It's definitely a question that everybody's going to have a different perspective on, but I think it really boils down to understanding the company's story and the numbers, story being the qualitative analysis and numbers being the quantitative analysis, and then having an idea or a level of conviction on that company, and then just sticking to it, revisiting the story, revisiting the numbers, see if it makes sense. If it does, there's no need to do anything. And if it doesn't anymore, then yes, you can make some changes by buying or selling or whatever the case might be. Oftentimes, our mind ends up being the biggest enemy to our investing returns and our trading decisions, because what we're trying to do is we're trying to take emotions out of our investing as much as possible, but it's a difficult thing to do. The things that I've noticed over the years is less is more. The fewer decisions you end up making, the better off you're going to be long term. Sometimes you just don't need to go in your portfolio and make too many decisions, because you're really going to ruin your long-term returns. Just sit back and just let the markets do its thing. Let the money work for you, and you can just sit back and enjoy those gains. Okay, so Snowflake. A lot of people asking for insights on Snowflake. I mentioned that in our Discord, so make sure that you do check that out, because again, it's kind of hard to go over every single stock because we do end up spending a lot of time. If you do have time after Jerome Powell's speech, maybe we can spend some time on it. But right now, let's just get ready for Jay Powell's speech here. It's going to be happening very, very soon. So here we go. We're just going to be waiting. The event will begin soon. I'll do an audio check, and then we'll listen in to what Jay Powell has to say. Do me a favor, everyone. We are very close to 82,000 subscribers. All I want is for you to drop a like and subscribe to the channel if you haven't already. Really, really helps us out. Greatly appreciate it in getting us to that goal. And welcome to the community. Happy to have you on board with us. If you have any questions, we're all here to help you. Doesn't matter if you're a beginner investor, trader, if you're, have some experience or you're, super experienced. There's always a place for everybody so that we can help grow this community and, again, find resources together to help each other with our investing and trading journey. So that's what we're all about. Ishwar says, let me unsubscribe. So Reddit has a potential for strong growth in ads like Instagram, TikTok, Facebook, and to be bought out by Meta. So Brian, I think it's a great question. It's a great analysis, but at the same time, I feel like Reddit has a very similar business model to Twitter. I think any text-based social media is going to be difficult to monetize. I guess you can make a case that Reddit is very similar to Facebook, where there's going to be ads in different formats, but Twitter has been a very, very difficult social media platform to advertise and monetize because of the way it's built, right? You're mostly there for reading tweets, right? Text-based tweets. You're not there to watch content. You're not there to consume videos or different forms of content like Instagram Reels or Shorts or whatnot. It's really just for text-based content. It's really difficult to advertise on those platforms because impressions and click-through rates are not as high as what they might be on a video-based platform. That's why YouTube has been significantly more successful than Twitter, of course, Instagram Reels, and even Facebook to some extent. That's why I said Reddit can be compared to a little bit of Facebook if you do that comparison. And then I also believe that Amazon's advertising, I think long-term is going to be significantly better than compared to YouTube. We already know that. That was one of the reasons why I was betting on Amazon in the first place, is because Amazon's advertising was still very much under-tapped. And then eventually it took over YouTube's revenue. Why? Because it just makes sense. Like if people are going on the Amazon website, they're going there to buy something. They're going there to buy, products, different products that they may find interesting or they're looking for. So for any retailer, for any advertiser, it makes a lot more sense to advertise their products on Amazon than it does on YouTube, because YouTube, you're not going there to watch to buy something. You're going there to consume content, to watch content. But with Amazon, it's a whole different proposition. So I do believe that Amazon's advertising business is still got a lot of potential, a lot of runway ahead of it in the future. And of course, we got AWS to make it more profitable. So Amazon, I believe the growth rate for Amazon is going to be much higher than maybe Meta or Google for that matter. So Lippy BK, that's a great question. I am about 45 days only, just dipping my toes into equity investments. Where should I start? Do I need to day trade? No. Please don't start with day trading if you're just getting started. I would suggest definitely do test out different strategy if you were using a simulation or a paper trading account. If you want to actually test out different things, you don't have to lose real capital to experience or test different things out. Definitely test it out in a simulation in a more controlled environment. But in the meantime, I would definitely recommend learning as much as you can about fundamentals and technicals and how to analyze companies and how to analyze stocks. Both are different things. Companies more fundamentals, stocks more technicals, and then just really working on your own personal development as an investor / trader. Whatever strategy you decide to go with, it's going to come, right? It's going to happen over time. You just need to really spend some time in understanding the market basics, fundamentals, technicals, like I said, so that you can have a much better experience long term with fewer mistakes and fewer money lost. Because we've already done that. I'm sure a lot of people here who first got started with trading or investing, lost money, blew up accounts. I'm sure people have blown up accounts many accounts. I've blown up a couple accounts myself 10 years ago, so it's pretty normal, but you don't have to do that. You can start with very simple understanding of fundamentals and technicals. What is a good website to practice trading? TradingView. TradingView has a very good simulation. You can pretty much come over here, and you can start with the TradingView. Look all the way down here. You'll notice the trading panel, and you can paper trade. You can see it right there. They're running some competition. Paper trade for your chance to grab a piece of 45,000 or whatever. You can participate in that competition or not, but you can, again, over here you can see brokerage paper trading simulated by TradingView. It's a very, very nice way to get started and learn. So that's available right there. Anyway, so 4 more minutes left, folks. We've got Jerome Powell coming on very, very soon. So again, we'll be listening in to what he has to say. I'm going to do a bit of an audio check. I'm going to minimize this. And we're going to minimize this as well. TradingView really seems to be sucking a lot of energy out of my computer, which is why it's lagging a lot, I feel. So what we're going to do is we're going to put Nvidia over here to the bottom left. I'm going to put the S&P 500 on the bottom right. And then we're going to put this over here. There we go. So the event will begin soon. We're just about a couple minutes away from Jay Powell. We've got the QQQs over here at the top right. And then we've got the S&P 500 at the bottom right. Both of them are green. Both of them are pushing higher right now. But like I said, we'll be doing an audio check very, very soon in the next couple minutes as soon as this begins. And then we'll take a look and listen to what Jay Powell has to say about the markets. Hope you all are ready. So in our poll right now, we've got 35% green, 31% very green. So 67%, 66% of investors right now are expecting for a green to very green markets today. And then we've got about 34% red to very red. It can be the internet. I think it just might be TradingView and my laptop. My laptop may need some updates that I may need to run. I think that might be it. So Coder, I never understood how people blow up their accounts. Like, how do they let it get to that point? Emotions, man. When you're first getting started, there's a lot of emotional sort of investment. And hold me, I will definitely connect with you. You can either send me an email or you can message me on Instagram. You can connect with me there. My handle is going to be CastWRP. So you can connect with me there also. But yeah, I mean, there's a lot of emotions involved when you're first getting started with trading. So it's pretty normal to blow up accounts if you're first getting started. But no, TradingView is a very good platform. I've been using it for well over, I think now 7 years or 8 years. It's got paper trading. It's got simulation that you can do. A lot of trading strategies. You can pretty much create your own scripts. You can backtest a lot of data. So it's amazing tool for when you're first getting started. Netflix for the next 3 to 4 months. I feel like it's a little bit more overbought right now. I wouldn't be surprised to see it cool off just a bit. Oh, here we go.
2 papers, and we also have a panel lined up for that. But before we get to any of that, I am delighted to say that we have Federal Reserve Chair Jay Powell here to deliver opening remarks. So with that, let me welcome Jay Powell to the podium.
Thank you, Karen, and thanks to our host from the Kansas City Fed. It's great to be back here today. 4.5 years after COVID-19's arrival, the worst of the pandemic-related economic distortions are fading. Inflation has declined significantly. The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized, and the balance of risks to our 2 mandates has changed. Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored. While the task is not complete, we have made a good deal of progress toward that outcome. Today, I will begin by addressing the current economic situation and the path ahead for monetary policy. I will then turn to a discussion of economic events since the pandemic arrived, exploring why inflation rose to levels not seen in a generation and why it has fallen so much while unemployment has remained low. So let's begin with the current situation and the near-term outlook for policy. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. The FOMC's primary focus has been on bringing down inflation, and appropriately so. Prior to this episode, most Americans alive today had not experienced the pain of high inflation for a sustained period. Inflation brought substantial hardship, especially for those least able to meet the higher costs of essentials, like food, housing, and transportation. High inflation triggered stress and a sense of unfairness that linger today. Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Turning to employment, in the years just prior to the pandemic, we saw the significant benefits to society that can come from a long period of strong labor market conditions. Low unemployment, high participation, historically low racial employment gaps, and with inflation low and stable, healthy real wage gains that were increasingly concentrated among those with lower incomes. Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%. Still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated, and all told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. So let's now turn to the questions of why inflation rose and why it has fallen so significantly even as unemployment has remained low. There's a growing body of research on these questions, including Gowdy Eggerson's work, which we'll shortly discuss, and this is a good time for this discussion. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone. The arrival of the COVID-19 pandemic led quickly to shutdowns in economies around the world. It was a time of radical uncertainty and severe downside risks. As so often happens in times of crisis, Americans adapted and innovated. Governments responded with extraordinary force, especially in the United States. Congress unanimously passed the CARES Act. At the Fed, we used our powers to an unprecedented extent to stabilize the financial system and help stave off an economic depression. After a historically deep but brief recession, in mid-2020, the economy began to grow again. And as the risks of a severe extended downturn receded, and as the economy reopened, we faced the risk of replaying the painfully slow recovery that followed the global financial crisis. Congress delivered substantial additional fiscal support in late 2020 and again in early 2021. Spending recovered strongly in the first half of 2021, and the ongoing pandemic shaped the pattern of the recovery. Lingering concerns over COVID weighed on spending on in-person services, but pent-up demand, stimulative policies, pandemic changes in work and leisure practices, and the additional savings associated with constrained services spending all contributed to a historic surge in consumer spending on goods. The pandemic also wreaked havoc on supply conditions. 8 million people left the workforce at its onset, and the size of the labor force was still 4 million below its pre-pandemic level in early 2021. The labor force would not return to its pre-pandemic trend until mid-2023. Supply chains were snarled by a combination of lost workers, disrupted international trade linkages, and tectonic shifts in the composition and level of demand. Clearly, this was nothing like the slow recovery after the global financial crisis. Enter inflation. After running below target through 2020, inflation spiked in March and April 2021. The initial burst of inflation was concentrated rather than broad-based, with extremely large price increases for goods in short supply, such as motor vehicles. My colleagues and I judged at the outset that these pandemic-related factors would not be persistent, and thus that the sudden rise in inflation was likely to pass through fairly quickly without the need for a monetary policy response. In short, that the inflation would be transitory. Standard thinking has long been that, as long as inflation expectations remain well anchored, it can be appropriate for central banks to look through a temporary rise in inflation. The good ship transitory was a crowded one, with most mainstream analysts and advanced economy central bankers on board. I think I see some former shipmates out there today. The common expectation was that supply conditions would improve reasonably quickly, that the rapid recovery in demand would run its course, and that demand would rotate back from goods to services, bringing inflation down. For a time, the data were consistent with the transitory hypothesis. Monthly readings for core inflation declined every month from April through September 2021, although progress came slower than expected. The case began to weaken around mid-year, as was reflected in our communications. And beginning in October, the data turned hard against the transitory hypothesis. Inflation rose and broadened out from goods to services, and it became clear that high inflation was not transitory and that it would require a strong response if inflation expectations were to remain well anchored. We recognized that and pivoted beginning in November. Financial conditions began to tighten, and after phasing out our asset purchases, we lifted off in March of 2022. By early 2022, headline inflation exceeded 6% and core was above 5%. New supply shocks appeared. Russia's invasion of Ukraine led to a sharp increase in energy and commodity prices. The improvements in supply conditions and the rotation in demand from goods to services were taking much longer than expected, in part due to further COVID waves in the United States. and COVID continued to disrupt production globally, including through new and extended lockdowns in China. Higher rates of inflation were a global phenomenon, reflecting common experiences: rapid increases in the demand for goods, strained supply chains, tight labor markets, and sharp hikes in commodity prices. The global nature of inflation was unlike any period since the 1970s. Back then, high inflation became entrenched, an outcome we were utterly committed to avoiding. By mid-2022, the labor market was extremely tight, with employment increasing by 6.5 million jobs from the middle of 2021. This increase in labor demand was met in part by workers rejoining the labor force as health concerns began to fade, but labor supply remained constrained. And in the summer of 2022, labor force participation remained well below pre-pandemic levels. There were nearly twice as many job openings as unemployed persons from March 2022 through the end of the year, signaling a severe labor shortage. And inflation peaked at 7.1% in June 2022. At this podium 2 years ago, I discussed the possibility that addressing inflation could bring some pain in the form of higher unemployment and slower growth. Some argued that getting inflation under control would require a recession and a lengthy period of high unemployment. And I expressed our unconditional commitment to fully restoring price stability and to keeping at it until the job is done. The FOMC did not flinch from carrying out our responsibilities, and our actions forcefully demonstrated our commitment to restoring price stability. We raised our policy rate by 425 basis points in 2022 and another 100 basis points in 2023. We've held our policy rate at its current restrictive level since July 2023. The summer of 2022 proved to be the peak of inflation. The 4.5 percentage point decline in inflation from its peak 2 years ago has occurred in a context of low unemployment, a welcome and historically unusual result. So, how did inflation fall without a sharp rise in unemployment above its estimated natural rate? Pandemic-related distortions to supply and demand, as well as severe shocks to energy and commodity markets, were important drivers of high inflation, and their reversal has been a key part of the story of its decline. The unwinding of these factors took much longer than expected, but ultimately played a large role in the subsequent disinflation. Our restrictive monetary policy contributed to a moderation in aggregate demand, which combined with improvements in aggregate supply to reduce inflationary pressures, while allowing growth to continue at a healthy pace. As labor demand also moderated, the historically high level of vacancies relative to unemployment has normalized primarily through a decline in vacancies, without sizable and disruptive layoffs, bringing the labor market to a state where it is no longer a source of inflationary pressures. A word on the critical importance of inflation expectations. Standard economic models have long reflected the view that inflation will return to its objective when product and labor markets are balanced without the need for economic slack, so long as inflation expectations are anchored at our objective. That's what the model said. But the stability of longer-run inflation expectations since the 2000s had not been tested by a persistent burst of high inflation. It was far from assured that the inflation anchor would hold. Concerns over de-anchoring contributed to the view that disinflation would require slack in the economy and specifically in the labor market. An important takeaway from recent experience is that anchored inflation expectations, reinforced by vigorous central bank actions, can facilitate disinflation without the need for slack. This narrative attributes much of the increase in inflation to an extraordinary collision between overheated and temporarily distorted demand and constrained supply. While researchers differ in their approaches and to some extent in their conclusions, a consensus seems to be emerging, which I see as attributing most of the rise in inflation to this collision. All told, the healing from pandemic distortions, our efforts to moderate aggregate demand, and the anchoring of expectations have worked together to put inflation on what increasingly appears to be a sustainable path to our 2% objective. Disinflation while preserving labor market strength is only possible with anchored inflation expectations, which reflect the public's confidence that the central bank will bring about 2% inflation over time. That confidence has been built over decades and reinforced by our actions. That is my assessment of events. Your mileage may differ. So let me wrap up by emphasizing that the pandemic economy has proved to be unlike any other, and that there remains much to be learned from this extraordinary period. Our statement on longer-run goals and monetary policy strategy emphasizes our commitment to reviewing our principles and making appropriate adjustments through a thorough public review every 5 years. As we begin this process later this year, we will be open to criticism and new ideas while preserving the strengths of our framework. The limits of our knowledge, so clearly evident during the pandemic, demand humility and a questioning spirit focused on learning lessons from the past and applying them flexibly to our current challenges. Thank you.
Folks, what a move in the markets here. So we got the S&P 500 about 20 points away from all-time highs. Again, that was a bit of a recap from what's already happened in the economy, from, of course, inflation coming in, Federal Reserve obviously increasing interest rates to combat higher inflation. Now, the interesting thing is we're going to have to see whether these gains actually hold up during the day or not. The NASDAQ 100 is up over 1.3%. With most Magnificent 7 companies. If you take a look, Tesla up 4%, Nvidia up 3.7%. We've got Google up 1%, Apple up 1.3%, Amazon's up almost 1%, Microsoft up over 60 basis points. We did get the purple tie, so about 20% of us were expecting for the purple tie here. But again, we'll see if the markets can keep these gains higher, which we're starting to see some selling pressure here. And if we actually end up at 478 on the NASDAQ 100, we'll practically be at the same level as before Jay Powell's speech. So pretty much all of those gains could get eroded if the markets start to rotate back lower. S&P was about 20 points away from, like I said, new all-time highs. And we're starting to roll over on this candle. Still up, still green. But of course, we're not very, very green. We're about green, 37% of you guys expecting for green here. So we're almost at 800 votes. I'm going to close this poll at 800 votes. Three more needed to get to that level. But overall, again, addressing the recap of what's already happened. But he did mention that it's time to now shift policy. Now, that was one of the biggest reasons why the markets rallied. That was right about 10 a.m. Eastern, because that was within the first 5 minutes of his statement, mentioning that there is now the time to shift policy stance, which was a huge signal to the entire market, suggesting for September rate cuts. That's at least how I interpreted it. Obviously, not discussing too much about the revised jobs numbers that we got from the last year, about 818,000 job revision to the downside from the BLS that we just received on Wednesday. But nonetheless, a very, very dovish tone from the overall Jackson Hole speech here, suggesting for a shift in the overall policy and thereby implying some rate cuts, as we already know that 100 basis points is what the markets are pricing in now. But the real question is going to be if that is going to be accompanied with a recession or not. And again, there's a lot of investors, strategists, people that are expecting for a recession to be accompanied with these rate cuts because of the very fact that this has been the longest inversion of the yield curve, the jobs report being very much misguided by the BLS, and it's not really showing us the accurate picture. So a lot of things still suggesting for a recession, but like I said, it's not for us to make a prediction on whether there is going to be a recession or not. Our job is to be prepared regardless of what ends up happening. Stay invested, in my opinion. I think it's really important to stay invested, continue to take advantage of these market momentums, because you really don't want to sit out a day like today where, NASDAQ's up over 1.2%, individual stocks up 4 or 5%. We also want to take advantage of raising more cash, getting more cash by selling calls or increasing more buying power for if and when there is opportunities to buy once again. I also want to clear up the Nvidia trade that I took, and I'm actually planning on selling more puts today, is a bullish trade. It is not a bearish trade. By selling puts, you are actually taking a bullish stance. You're expecting for prices to go up because that's when the put option gets further out of the money, and that's how you actually get to keep the entire premium. So that is a bullish trade. I want to be very clear, because every time somebody hears puts, they think it's a bearish trade automatically. I also want to mention that we are almost at 1,400 viewers right now. So thank you so much for joining, everyone. I really appreciate it. It's a bit of a channel record for us, getting up to almost 1,400 viewers. So again, thank you so much for being a part of our morning live stream. Make sure that you drop a like and subscribe to the channel. We're almost at 82,000 subscribers here, so I would really be grateful for that. So Magnificent 7 continues to move up. Volatility here, let's take a quick look, down almost 6%, but again, we'll see if the markets can keep up with these gains here intra-day. We're already starting to see a little bit of those red candles, but we're still well up over 1% right now. So S&P up almost 90 basis points, and of course the Nasdaq here up a little bit over 1.2%, with majority of stocks pushing higher. So I'm sure the heat map looks very green right now. So let's just go ahead and pull up the heat map here on a new window, and we'll take a look at what that looks like for the day. So there we go. Lots of momentum here. Of course, Nvidia up over 3.2, Broadcom, Tesla. There's momentum across the board for almost every sector and stock out there. If you come over to ETFs, you'll notice that TMF and TLT also doing really well. The only ones that are selling off on the day, of course, are inverse ETF for the right reasons, because the bullish ones are going higher. TQQQ is up over 3.5%. We have UPRO up over 2.6%. SOXL up 7.4%. A lot of momentum on semis, with the TNA, which is small caps, up almost 5%. And then, of course, volatility ETPs. We've got inverse ETFs, and then some other TZA and SOXS. That's where the pain is coming from on the day. I also want to go over the interest rates. So this right here, if you take a look at the US 10Y, the 10-year yields on this news of a potential shift in the overall stance of monetary policy, down about 1%. We're now down to 3.8% here for US 10-year treasuries. So again, this is a pretty low number. If we continue to break down further, there is possibility for us to see that number come down to as low as 3.3%. That would be the next target to watch on the 10-year treasuries. And TMF, I'm sure, is ripping higher on the day, so up a little bit over 1.6%, although starting to roll over just a little bit. But TLT also green on the day. So there is a lot of liquidity flooding into equities, into bond market, as we start to see a bit more of a risk-on environment in the markets at the moment. So that's where we are. I'm going to end this poll and come over to some of the chat. So is IWM a better buy now? So IWM, in my opinion, is a buy. Whether there is a better buying opportunity, I think with rate cuts, there's always a bullish tailwind for small caps. So yes, I do believe that IWM is an ETF that I'm particularly interested in. I'm actually invested in IWM. Will most likely buy a little bit more. So yes, I do like IWM. Michelle says, you rock. Appreciate the grounded and objective information you share. My top YouTube I watched lately. Let's go investors. So thank you so much, Michelle. I really appreciate that. And yes, I think the only idea is for us to not get super hyped up with the gains or the losses, and have a very objective, rational approach to investing, and a balanced, holistic overview of where we are with regards to technicals, valuations, the volatility, the Money Vest Index, everything, combine all of that and make more confident investing, trading decisions for ourselves. So that's going to always be the philosophy of the channel here. So thank you so much. I appreciate that. So Junior Sun says, as I said earlier, buying at yesterday close was a good long. So I agree. I think yesterday's sell-off was quite good opportunity for a short-term trade. However, we still don't know if this is going to continue. So we're going to have to wait and see how the markets close out. And S&P, there's possibility for us to new all-time highs. If you believe that we're going to see a new all-time high for S&P 500 on the day today, type in, I want to see rocket symbols for all-time highs on the S&P. And then if you believe that we're not going to be able to get up to that level, then just simply let's see, like a blood emoji. Let's do that. Okay. So if you believe a rocket, in other words, S&P 500 to new all-time highs, then definitely let us know with this emoji over here. Or if you believe no all-time highs today, then it's going to be this emoji over here. Let's see. Let's see how many people here are expecting new all-time highs. We're only about 30 points away from all-time highs on the day today. So S&P 500 would need to go up another 30 points, or in other words, another, let's see here, there's only 0.5% gain needed for S&P 500 to get up to all-time highs here, and break that 56.69 barrier, getting up to all-time highs. So we've seen mostly rockets, very few blood emojis, meaning a lot of investors, a lot of people expecting for this bullish momentum for us to carry us forward to new all-time highs here. Incredible. That's amazing. That's awesome. Again, we have to be grounded and understanding of the very fact that, yes, there's a lot of bullish sentiment out there. And that's what's paying off in the last couple of weeks here as we take advantage of the sell-off in the S&P 500 and the Nasdaq, of course. Let's take a look at Tesla as well. And is it a good time to sell Nvidia calls? Dilip says, I believe yes, because the gain is very good on the day. So you're going to get some very good premiums on calls for Nvidia. But just make sure that you understand that your strike price needs to be above your cost basis. Otherwise, it would be a losing trade if you end up getting assigned or exercised at a strike price below your cost basis. So always make sure that your strike's above your cost. And also, it's a price where you're comfortable letting go of your shares. It's a price that you are okay letting go of your Nvidia shares, and you're comfortable with that. So Tesla, support level at around $208. So that is a level that we're going to be watching very closely, with a resistance all the way up to $233 for Tesla. So that is going to be that level to keep in mind. And right now we're still, I would say, within the context of a bit of a downtrend, but a very nice gain on the day, up over 4.6%. Nvidia really running up. I wasn't able to position completely out into that trade. So, still up on the put that I sold yesterday. But my goal was to sell 5 or 6 more. I'm still going to do that today in anticipation of next week's earnings. But of course, the premiums have already moved up. Like I was looking at $104, $105 puts that were selling for about $1.20. They got up to as much as $1.25. And now those same contracts, 30 minutes later, trading down to $60, 60 cents. 60 cents on the dollar, 70 cents on the dollar. So those are significantly lower than compared to about 30 minutes ago. But that's what it is, right? This is why we do it, because there's going to be movement, there's going to be volatility. And we saw a pretty significant intraday price action on a lot of tech stocks. Maybe not so much on the market, but definitely on Nvidia, on Tesla, both up over 4%, almost approaching 5% gain on the day, with, of course, Amazon up 1.4%, Apple up 1.6%, the semiconductor, 2.3%. So if you come take a look at the semiconductor watch list, everything green. So if you take a look here, we've got Intel selling off, on semis, super micros down. Nope, they just got updated. So it wasn't updated earlier. So yes, most companies up, with Micron being the only one that is down over 30 basis points, but everything else is up over 4.6% on semi, Intel, TSMC, Broadcom, SMH, of course, the one that we have, up to $250 now. And then not to mention Qualcomm, Advanced Micro Devices, then Texas Instruments, Lam Research, everything pushing higher. Folks, we are 50 subscribers away from 82,000. So all I would ask you is that if you're enjoying the content, if you're finding it helpful, make sure that you are hitting that subscribe button so you can join us in our future live streams as well. Getting up to that goal is very important. Okay, Max says markets only go up. For now, yes. Because the markets care very much about the earnings. Earnings have held up really well. Everything really comes down to earnings and what that's going to do to earnings. And right now, as it stands, earnings are still very strong. And with the interest rate cuts coming in, as the markets are now fully pricing in for a rate cut in September, at least by a 25 basis point, that is a very bullish sort of trade altogether. Because quantitative easing, the beginning of quantitative easing, when it's not accompanied with a recession, is a good environment to be in. You're going to be able to borrow money cheaply. Investment activity is going to pick up. Spending activity is going to pick up. And that's going to really be a big relief for a lot of people, households, individuals, and businesses that have struggled with higher levels of interest rates for a really, really long time. So that is, in general, a very, very good environment to be in. So this is Russell 2000. Just very, very nice move on the 5-minute from about 8:30 a.m. Eastern to where it is now, a over 1.6% move higher. SPY RSI is 82 now on the 15-minute chart. Yeah, so I'm sure because of the momentum that we're seeing for the markets. As soon as he started talking, all the candles just went berserk. It kind of went out of the chart on our trading views. It was actually quite crazy with the entire momentum here. So yeah, 56.39. We're gonna wait until we get to all-time highs. Looks like it's possible to get to that level here on the day. We just need to make a new high of day in order to get to that. In order to get to that possibility of all-time highs here. Yeah, 56.69. We're very, very close, people. 56.42 would be the first level that we need to break out of yesterday's high, and then we are off to the races for all-time highs here potentially. Only a 0.5% move higher. 0.5% is going to get us there to all-time highs. Love to stay live until all-time highs. It's gonna be quite the challenge here. Another 0.5% is not easy. There has to be a lot of momentum coming in from these companies like Tesla, Nvidia, all these companies. But yeah, I mean, I'll be planning to, like I said, sell some more puts on Nvidia. We'll keep a close eye on what those put premiums are. So right now, for example, I'm looking at them. The 105, the one that I sold yesterday, I sold it for $1.17. It's now trading at 68 cents. Which is up like almost 40% from the time I sold it, so that's good. If I go up to $110, $13, man, this was at $90 just a few minutes ago, 40 minutes ago. $115 now at $2, but again, the higher we go, the closer we get to the money, because Nvidia right now is trading at $129, same price level where it was yesterday before the sell-off. So let me ask everyone, what is your expectations for Nvidia next week? Is it ripping after earnings, or is it going to be coming down? Should we do a poll? Should we do a quick poll for that? Nvidia post earnings next week. Rocketing higher. Crashing lower. Let's see what everyone thinks for Nvidia next week here. Participate on a new poll we've got for Nvidia, and I really want to see where the consensus is. Where's all the expectations for Nvidia? 87% right off the bat. Wow, everybody is extremely bullish. I think we did a very similar poll in our Discord as well. I think we got like a 70-30 split for Nvidia pushing higher versus selling off. So I think a lot of investors like Dan Ives and a few other ones that I was watching earlier on CNBC, they are extremely bullish for Nvidia next week, kind of going over how this is going to be the most important earnings and how it's really going to dictate where we go with artificial intelligence. And if you come over to earnings calendar, expectations are high. I mean, it is quite priced for perfection here. So this is the big day, Wednesday, August 28th, next Wednesday. Nvidia, just over $29 billion of revenue. That's going to be over 100% increase on a year-over-year basis, and over 125% increase on earnings, with a 65 cents in earnings per share estimate for the company. It does trade at a forward valuation with a 3.9 M score. It does trade at a forward valuation of just over 30, I think. Well, now it's trading at much higher levels at 47. Considering how much it's recovered back up, but at one point it was trading down in the 30s, and that's where we are with analyst estimates. We got a strong buy rating, of course, 45 ratings, high target of 210, average price target of 139, and low target of 50, with analyst estimates for 2024 $1.19, 2025 $2.79 is going to be that number, which is obviously going to put us down to 33 times on a 2026 basis, 46 on a 2025 basis. Yeah, he always wears those ridiculous customs. True. So yeah, there we go. 60 cents for the upcoming quarter for Nvidia. So as it stands right now, we got 142 votes with 78% people expecting Nvidia to rip higher here post earnings, rocket higher. Yeah, demand is great for, it's moving faster. AI race equals more dollars. So I also do believe that it's going to rip. That's one of the reasons why I'm selling puts in the first place. 30 days out, Nvidia puts around 105, going for $200. Yeah, but 30 days out seems a bit too much because if you really do the math, $2 what you're telling me, so 2 divided by 103, we're looking at a return on collateral of about 1.9%, which isn't bad for 30 days. 1.9% for the entire month here times 12, we're looking at 22% annualized. It isn't bad, but you can also get 1% on the week, right? 1%, that's what, at least that's what we were getting up until yesterday on Nvidia puts. It was just over 1.1, 1.2% for return on collateral. And then it, of course, dropped like a rock after put premiums. Nobody wants to buy puts right now on Nvidia because it's so bullish. And that's why it dropped quite aggressively. And now put premiums and put yields are basically not that lucrative as they were yesterday. But nonetheless, I'm still planning on a trade. I'll let everybody know in Discord and where we end up being. And there's some concerns over Blackwell being delayed as well. So if there's any guidance that doesn't meet expectations, or if there are any quarterly updates where Blackwell delays continue, then there's possibility for us to see a bit of a pullback on Nvidia post earnings. So Elam says, even if Nvidia beats earnings, they will drop if it doesn't crush expectations. Yeah, guidance is really what it's going to come down to at the end of the day. I think for most companies, for most growth stocks at least, it's not really so much about the numbers being reported, but it's also very much about the guidance. What are they forecasting for the next quarter? Okay, markets right now, S&P starting to roll over a little bit. We're starting to see some pullbacks. And, still up over 1%, so that's good. NASDAQ also pushing higher. QQQ is up over 1.3. Magnificent 7. Still very green. Nvidia's up 4%. Tesla 4.5%. Let's take a look at some other stocks, shall we? Digital Turbine up 15%. Roku up almost 10. Marathon up over 5. Workday up over 10. Enphase up over 5.3. Fubo is up 5%, back up to over $2. Then we've got Coinbase up over 3.8%. Let's just quickly take a look at the fair value for Snowflake. I'll do an analysis on Snowflake if you guys can just subscribe. I've been getting a lot of questions on Snowflake. I feel like everybody is excited to learn about Snowflake. So I'll do an analysis on this company using our very own platform if you simply subscribe. I would really appreciate that. So looking at the fundamentals for this company, let's just quickly go over the revenues. Every single quarter, very nice consistent growth. So the top line is growing. But again, the problem with a lot of these SaaS companies, especially ones that are just getting started, I mean, it's been around for a while, but the thing is profitability, right? How profitable can it really get? It's got very high gross profit margins. So take a look, revenue, very nice consistent growth. Gross profit also very, very nice, consistently moving higher quarter over quarter, year over year. But if you remove for this and just come over to operating losses and net losses, it's been massive, right? It's to the downside and it's only accelerating further. This is as of the April quarter. Operating loss of 348 million, net loss of 316 million. And really what you want to see is the opposite trend, right? You want to see companies that are not only growing revenues and gross profit, but you're also seeing companies that are turning the corner towards profitability. Like if I show you Palantir, the reason why Palantir has been so strong, and it's done really well, and especially since the second quarter, actually the last quarter of 2022, is because of the quarterly numbers. Revenue, same as Snowflake, right? So if I plot that here, gross profit, again, very nice consistent growth. I would, also mention that gross profit margins are much higher for Palantir. And again, these are two very different businesses. I'm not making a comparison here, and I'm just showing you why it is so important for companies to turn the corner towards profitability. And then come take a look at operating loss and net loss. Both of these companies had a very similar trajectory for revenue and gross profit, but one of them actually turned the corner towards profitability in 2022. So take a look, December 2022, we had that switch. You can see that much better if I remove for revenue and gross profit. So right here, going from negative to positive and then accelerating higher. And that is, I think, very, very important for investors. And that's why we won't be able to calculate a fair value based on earnings or cash flows, because I don't think the cash flows are even positive for the business. Or maybe they are. Free cash flows a little bit. 324 million, 331 million. So on an annual basis, we're looking at free cash flows for the last year, $750 million. So they actually did turn the cash flow problem. So they are good on cash flows. 7 years, negative, and then 2022 positive cash flows, and then accelerating year over year to 750 million. I don't think they may have a debt problem either. I don't think they do, because total cash, 3.8 billion. Come down, plot for, let's say, long-term liabilities, 0, short-term liabilities, current portion of liabilities, and total liabilities. So yeah, balance sheet, amazing. They've got total cash sitting well over 3.8 billion. Actually, that's as of last year. Let's go over to quarterly numbers, and we'll go over to 8 quarters. Okay, so they've got cash 3.5 billion and total liabilities at 2.7. So they've got more cash than all liabilities combined. So balance sheet is good. But we also want to take a look at shares outstanding. How much have they been diluting shares over the last, let's say, 10 years, if you can find the data. So shares outstanding has been accelerating. They've only been around 5 years. So let's go over to 7 years here, or 5 years. And they've gone from 276 million to 328 million. So that's a dilution of 3.4%. Not terrible, but yes, reasonable. Milan, doesn't Buffett have tons of Snowflake? No. So he actually exited out of Snowflake completely in the past quarter that we just got the numbers for. Buffett sold all Snowflake in the last quarter. I think he made maybe some money. I think he may have made. But if you come over to Analyzer, and if you just do a discounted cash flow for Snowflake and project for 5 years, let's come over to fundamental analysis first. Let's take a look at analyst estimates. We've got profitability starting 2025 at 64 cents per share. That's the average earnings per share expectations, with a compounded annual growth rate that we don't have, but then 57%, 69%, and then 43%. So forward P multiple coming down as earnings are increasing from 181 down to 29. So free cash flow growth, we can maybe estimate for Snowflake, especially if you come over to the last 3 years, free cash flows have grown. Well, we don't even have 3 years worth of analysis, but they've grown by over 1,000%, 56 million to 750 million. So if you come over to Analyzer, plot for, let's say, 30% growth in cash flows and a terminal growth rate of, let's say, 5%, shares outstanding same, discount rate same, margin of safety same. If you hit calculate, overvalued by 41%. So the fair value ends up at $67 simply based on a discounted cash flow model where we're growing the cash flows by 30% and then 5% in perpetuity, and then a share dilution of 3.5%, margin of safety of 10%. And this right here is going to be the sensitivity grid or the matrix where you can figure out, okay, based on these assumptions, the fair value ends up at $67. Now, what would Snowflake need to hit in order to justify today's market price? We can also do that using a reverse discounted cash flow. So let's say that I go up to 50% here and then hit calculate. Now we are 14% undervalued. Let's say we go down to 45%. If we calculate about 2.88%, maybe we go up to 46. Maybe now we're going to be quite... So now we are aligned with the market, meaning the fair value is aligned with the market price. So that simply means that Snowflake would need to grow free cash flows by 46% for the next 5 years in order to justify today's market price as being the fair value. And that's also considering for 3.4% share dilution. If they dilute by more, if they dilute more shares, 5%, if you calculate, now we're 7% overvalued. So now it needs to achieve a slightly higher free cash flow growth rate of 47%, 48% probably, in order to justify today's price of $115. So you can use this calculator, run different analysis, figure out different things, plot for different analysis, different numbers, and see for yourself what makes most sense for you. That's why we've built this platform, is for investors like yourself to do full analysis on the company and figure that out for yourself and see what does the company need to hit in order for it to make sense based on the prices today, and what are the forecasts for the future. So Snowflake right now, if you come over to the technicals, we obviously have been selling off quite aggressively from its highs of well over 237, down about 51%. And we're coming up to a very strong support, right here at $109. But again, the fair value, of course, sits at much lower levels. And if you come over to the valuation statistics, we're looking at 14 times sales and a little over 50 times free cash flow. And of course, we don't have an earnings multiple because it's not profitable yet. So 14 times sales, it was at one point trading at 24 times sales. So very, very high, and a 92 times cash flow. So that numbers have stabilized, but yeah, wouldn't be surprised for it to be lower. But again, I mean, if you believe 47% growth in free cash flow is possible and there's a path to profitability, then I think there is opportunity here. We can also look at the net liquidation value. This is another valuation model that we've built, and the net liquidation value comes up at $13.66. That's basically saying that if they were to liquidate all of their assets at 100% recovery and liquidate all their liabilities or pay down all their liabilities, the liquidation value comes at $13.66, which obviously is significantly lower than where it is trading at the moment. But this is also a very, very deep discounting model. This is also used by the father of value investing, Benjamin Graham, then later practiced by Warren Buffett. So you can use this model as well, figure out for different recovery rates, how much of the assets they can recover, and then paying down all of their liabilities, and what is going to be that NLV per share value for that business. So that is also available. Anyway, coming back over to the market. So that was a full analysis on Snowflake in the last 10 minutes, as much as I could do it. And then we can, again, do more breakdowns in our future live streams. But we've been going on for, I think, a little over 2 hours now. Yep, so just over 2 hours. Thank you so much, everyone, for joining us for this live stream. I really appreciate it. And drop a like, subscribe if you haven't already. Let me see where we are with the subscriber count. We are at 81,953. So we still have about 40 people left in order to get to that target. So I would really appreciate that if you subscribe. Make sure that you drop a like. And as always, happy investing. Check out the links down below if you're interested in joining us. We've got a whole Discord community with over thousands of people, traders, investors from all over the world that you can engage in on an everyday basis. And again, talk about the markets, investing, trading, everything's going to be available, as well as access to our very own MoneyVest platform where you can do your own analysis, comprehensive fundamental analysis on individual stocks. So you can look at Lululemon, you can look at Zscaler, you can look at all the companies, over 17,000 stocks over there. So hope you all enjoyed this video, found it helpful. Drop a like, subscribe, happy investing. I'll see you all in the next video. Take care.